Thank you all for your patience. Really appreciate it. Make this worth your while. So, I'm gonna make this a monthly market call that we're gonna start doing, and basically start from 30,000 feet with what's going on in Canadian macro, and then boil it all the way down to what's happening with Canadian house prices, and then more locally with the Greater Toronto Area. I'm gonna do it in that order so that you're an agent from outside of the GTA, you can hop off when it becomes irrelevant for you. But I think the remaining factors are kind of relevant to everyone. Labid, can you just mute? There's a couple of hot mics. Can you just mute those, please? So just quickly, the new company that I'm with is called Valery. Website's valery.ca. We are an AI powered real estate brokerage. We help homeowners and realtors make more informed decisions using technology. So very quickly, because this is a kind of new initiative that I'm putting together for this year. My vision for these calls is really to keep doing what I do, which is just giving people free information about the real estate market, and especially what's happening in our economy and how that impacts what's happening in the local market, and so that we as real estate professionals can better advise our clients. So very quickly, City of Toronto house prices have basically been sideways since their peak in Q1 of 2021. Seems to be kind of the same story. So let's get a understanding. So first we'll start again, 30,000 people look at the macro. The first thing on everybody's mind, I would say, is the idea of tariffs and a trade war. You could see basically the massive exposure that Canada's economy when what the Canadian dollar did in response to Trump's comments in the morning that he was going to hold off on tariffs, and noon on saying that he was going to. There was there's this fear that trade war could become inflationary, and so Scotiabank put out this chart, and they felt that they might actually the Bank of Canada might actually have to hike rates if tariffs become inflationary. I don't think that will happen, but they did put this analysis out that we could see up to 300 basis points of hikes required if the Canadian government responds with to tariffs, because that would become inflationary. It would add, if they went 25%, it would add 25% to the price of goods. Monetary policy wouldn't really have the impact on that, so I don't actually think that that's a likely outcome. Probably a more likely outcome is the bottom, like below this chart, where basically rates will have to be cut in response to tariffs, regardless of retaliation, because if goods become more expensive, people buy less of them, and that'll have a continued drain on the economy. Regardless, I would say that these are net, like really, really negative. I wish I had better news, by the way, but I don't face it head on. The Bank of Canada has done a similar analysis where they could potentially have a 6% GDP. And you can see again, this is the Canadian dollars trading yesterday. Obviously, not anything out of control for most of the time. And then this is the morning when Trump said he wouldn't put the tariffs in, and you can see it jump up. And then in the afternoon when Trump said that he would put the tariffs in, and you can see it drop down. And so a lot of our economy and the way that the global economy is looking at Canada and whether or not this trade war starts. Bond yield didn't really feel the pressure, and this part's interesting from my perspective, and I'll get to why. But your bond yield's been kind of trending down. We're below 3% now. I think I haven't looked at it yet today because I've been mostly focused on putting this together. But your 5-year bond yield is a market because the majority of buyers are still using fixed rates, and that fixed rate depends on the bond yield. So what the Bank of Canada doesn't until we get to the point where your variable rates are significantly lower than your fixed, or if more and more consumers are using fixed rates. And so the bond market is really what's in control of the not the Bank of Canada, right? So if the Bank of Canada wanted to stimulate demand, the bond market would have to stop calling their bluff. The interesting part is that if you want to look at the bond yield curve, it's not an exceptionally accurate read, but regardless, it is still what our fixed rates are priced off of. But this chart shows basically how bond yields, what the bond market typically forecasted rates were going to do, all of the dotted lines, and then the solid line is what it actually did. So again, they're really good at predicting the outcome of the market. All of this being said, the report, which was Q4 of last year, indicated that the majority of mortgages being taken today were 3 to 5 year fixed. So you can see this red line here, and it's like the vast majority, like over 50%. And then the remainder is in the market, your short fixed, variables, etc. And so all of our mortgages really depend on those 5 months rather than your 1 and 2 year stuff, which again means that the demand side of Canada's market, the buying power that belongs to buyers who are using mortgages, is almost exclusively relying on bonds. And so I guess I want to, like, this is kind of one of those things that maybe is just worth clearing the air on, because I use the word housing correction a lot, and out this chart called the Brief History of Housing Corrections, which shows that we've actually seen national house prices in history so far. And again, more because I'm not saying it's going to happen. It already did. And so I guess I'm not characteristically bearish. I still am bearish, but like people can't call me a bear per se. But if you look at the way that, like I've said for a long time in a lot of my content that, you know, the setup for what we're seeing today was very, very similar to what happened in the 1990s. And if you look at the trajectory, I mean, you look at Vancouver in the 1990s and Ontario in the 1990s, we're very, very close to where those two markets are today. And so when I say the setup was similar, what I mean is in 1989, we saw immigration peak and what that, you know, kind of the impacts on that. During that same period of time, we saw house prices peak in 1989. We saw a credit cycle end, a housing cycle end, and we saw secular unemployment, or huge secular shift in unemployment, where basically we went into a long-term unemployment period throughout the 1990s. And so it is my guess that we're not going to see a quick rebound. If you compare to some of these lines that are labeled at the top, 08, 2018, 2017, Calgary in 07, and Calgary in 2015, these are all pretty short events. And maybe the two Calgary ones are a little bit longer. But what happened in Vancouver, Toronto was policy driven. It was B20 and the foreign buyer taxes in both of those markets. So Vancouver saw their foreign buyer ban in 2016. Toronto saw non-resident speculation tax in 2017. For a lot of you in the GTA trading, I'm sure you're familiar with this period of time. This is different, right? There's no policy that really did anything here. You could argue that the immigration policy might be exacerbating this issue, but to me, this is mostly an economic story. It's not a policy story. And so I would expect that we will likely see something more along the lines of Vancouver, Ontario, where we see a flat market for a long period of time. Ontario kind of trending down, but that's only like 2 to, you know, or maybe 5 to 10% downside risk from kind of where we stand right now. But really, you know, if you look back on it, it kind of looks flat, right? And I'll show you kind of all of this to say that the best case scenario, which is you're kind of, again, we shoot back up like Toronto or Vancouver in 8 months. So we should be planning for the worst case scenario. And I just kind of drew a line for those of you who can't see. The black line is really where we are right now. And so again, we're almost exactly where we're about 2.5 years. The interesting part, again, if you go to Ontario, and I'm just going to try and find this in my tab. If you're a realtor, you would have had this in your inbox probably, but this is from the recent Abacus and Ontario Real Estate Association survey. And I would encourage you to go through this and really data, and because it was a good poll. And you know, housing affordability is becoming a primary issue. It obviously has been for several elections, but it takes policymakers a really long time to figure this out. And so to me, there's probably a policy aimed at creating affordability for better or worse. Again, encouraging the more construction of the homes in the province. We'll see. We just saw, you know, the last municipal elections and federal elections run kind of on a housing platform. It wouldn't surprise me if we see 2 elections in the province of Ontario this year. We know is going to happen. That's going to be run almost exclusively on housing. And then in the province of Ontario, it wouldn't surprise me if Doug Ford calls an election, simply because I think he sees it as being winnable. And we'll see another election based on probably primarily facing Canadians at this point. If we go back to kind of thinking about some of these corrections that I showed you before, if we look at the 1990s, housing affordability peaked at about 85% of median household income in the city of Toronto, a little bit less, and then 55%. This housing cycle, every city has exceeded their 1990s peak except for Calgary. Montreal is rolling over. Calgary is still getting less and less affordable. I think that this data is lagging, so prices are kind of rolling over a little bit there. But if you look back at a lot of these housing cycles, you can see there's 2 peaks, right? So these 2 peaks are when house prices rise, inflation period, and the central banks as intervene here. They do so with interest rates, and then when they when they hike rates, prices tend to drop a little bit, and you saw that first peak there. And then what happens is prices sort of settle, and the rates continue hiking, and so the negative impact or the improvement in affordability is no longer significant enough to outweigh the second peak, that cost of capital going up. And that's why you see the second peak in most of these scenarios. You can see a double peak in a lot of these past housing corrections. And so once you come over the second peak, that is when interest rates have done their job and the central bank says, okay, we've beat up the economy enough, let's start bringing rates down. And that's where you see this huge drop, this huge improvement in affordability, which is where your prices are already suppressed. In some cases, if you're in a recessionary territory, that's where you see these gray bars here are recessions. And all of them interest rates now coming down. And so that's what you can expect here in across Canada. You can see it in basically every city. This comes from National Bank, by the way. If you just Google National Bank Housing Affordability Monitor, they publish this on a quarterly basis. And this is a chart that I on kind of what a housing cycle looks like and what they can expect. That we're seeing right now is that the income is, according to RBC's recent reports, income is really the driving factor that's improving affordability a lot, because we have wage growth that is actually outpacing inflation, even though unemployment is rising. So I'd say as long as they're outgrowing prices, income is doing actually the most of the work in improving housing affordability. That's not how it should be, by the way. And so again, central banks probably still have a bit to get housing affordability to improve. And I will note that the reason that we're not seeing housing affordability improve from housing costs is we haven't really seen anything major in interest rates in a series of smaller cuts. And then you've also got a lot of your markets across the country that are actually going up in price. So basically, any market that is relatively affordable, if you go on a year-over-year basis, has up in value. The places where you're seeing drops in value is in less. This chart or matrix here comes from Scotiabank. They basically comes from Canadian Real Estate Association's Market Watch, and they just put it in a matrix, and anything that's positive is green and anything that's negative is red. And so to me, you can see the market's kind of bifurcated into 2 different segments. The top is where you see your markets that are still affordable, and this is based on that chart that I showed you, mortgage payment as a percentage of monthly income, basically where incomes can keep up with house price growth. And you see sale prices, the middle column here, are more green than red in those affordable markets, right? Let's set aside listings and unit sales. In unaffordable markets, you can see the sale prices are more red than green, and that's across the last month, last 3 months, and last 12 months. So again, unaffordable still feeling the pressure where incomes can't rise, or even if incomes do rise, the incomes already weren't good enough to buy a house in Vancouver, Toronto, London, etc. And so incomes still need to rise a lot more before you see a affordability return in those markets. And so the problem is there's limited upside in those markets if our in saying that again, income playing a significant role in improving housing affordability. Um, we need something else here if we're going to see housing affordability return. And that means the cost of ownership needs to come down. That can happen in one of two ways. It can happen with mortgage rates coming down, or it can happen with house prices coming down. And my guess would be, barring any, major changes in the Canadian economy take place in some fashion over the next little bit. When I go back to talking about sideways markets, you can see the peak of the market here. We're all familiar with that period of time. It was a party. And then Tiff Macklem, came in and shut the music off with rate hikes. And since that, we saw a pretty severe drop, a little bit of a bounce, and the market kind of, honestly, I would really just think of this as like you throwing a ball. You see the big one, and then you kind of see these like little rebounds, and those are your two bounces. And then eventually, I think you just kind of end up, and you can see the trailing 12-month average is basically flattening out. The market will trade sideways until basically, if you were to draw a straight line from your average price growth, your return to the mean, it might come down a little bit, and then you kind of get back to that mean growth. But if you just draw a straight line, then eventually we'll catch that average growth. So I think it would kind of come out here. So if you trade sideways for another year or two, then you could start thinking about recovery a little bit sooner. The interesting part is a lot of this comes from like skewing in data, because Ontario and BC make up like greater than 50% of the residential average price statistics. And so this is kind of one of those challenges. Like Ontario's, I think, like 45%, and BC is like 15% of like transaction volume, because their prices are so high relative to the rest of the country. And so, I mean, year over year on a provincial basis, the only, this is average price, and this is Canadian Real Estate Association stats. The only market that actually saw a decrease in price was Ontario, yet the national average is flat, let's call it. And that's because even though huge gains in places like New Brunswick, PEI, Newfoundland, your Ontario, the little drop in Ontario was able to pull it back down to kind of that closer to zero. And again, a lot of these, your Quebec, New Brunswick, Nova Scotia, PEI, Newfoundland, Ontario and BC. The reason that they're seeing growth and is because, again, they're affordable markets, and those markets are growing with people's income, and they're also growing with people leaving places like Ontario and BC to go to some of these more affordable markets. You do see a big migration into those areas where there are decent jobs, help you afford to live a normal life. What this is materialized in is people are buying homes again, and so your monthly home sales are actually, they drop below again the 10-year monthly moving average in December. But basically, we spent the period after the rate hikes until 2 months ago. We spent that period of time under the 10-year monthly moving average. So from my perspective, anytime that we black line here, the real estate market was in recession. And usually you see, I've showed this graphic a couple of times. I don't have it in this deck, but if you just search Hope, H-O-P-E, and then Cantro, K-A-N-T-R-O, named Michael Cantro acronym, where it shows how the market responds to changes in interest rates. And the first thing that gets impacted is housing. So housing got impacted very, very early, almost instantly. House prices came down, volume dried up, and the realtors were in recession because people weren't buying houses because the market sucked. And then you start to see the second order effects of that drain on the economy over the next 2 years. So people aren't buying and selling houses, so they're not buying decks, and contractors are making less money, and Home Depot is making less money, and now profits are suffering, and then employment suffers. We're just getting to the employment suffering part. And then once you get to rates coming back down, the first thing to feel it is housing, and then your contractors, and then your Home Depot, and then your profits, and then your employment. That's how the recovery scenario plays out. So right now we're not in the phase where prices are recovering, but we're in the volume is starting to recover because people can afford houses. Korea's forecast is that we won't see prices grow that much this year, but we will see volume grow. That I think that's probably the best thing for this year. In regards to listings, we're in a pretty normal market, I would say. I don't think we're seeing a supply flood, because that new listings are outpacing demand, or supply is outpacing demand. So if I go over to, I don't know where that went, but anyway, you're not seeing as many sales as you are listings. And so if that continues and all of those become, active supply or active listings, and that we have this continued accumulation of supply market in the spring of next year. Getting to the employment piece, I use Toronto's unemployment here. This comes from Korea and Statistics Canada, but Toronto has one of the worst unemployment rates in the country, over 8%. Employment's like 6.8. We saw a little bit of relief on that in December, but I think that unemployment is really the big thing to watch from my perspective. If you go back to like the 2020, where Pierre Poilievre was interviewing Tiff Macklem, he asked about how much people could weather the storm of a 200 basis point increase in their mortgage rate. And Tiff wasn't concerned about that. And it appears, based on what we're seeing in the market right now, he was right to not be concerned about that. But he did say something that was really important. He said that the biggest reason to pay their mortgage is if they don't have a job. And now we're getting to the point where there are a lot of people who aren't having jobs, or more people than relatively in the past. And so I think that the unemployment rate, if it continues to climb, is what will lead, potentially more debt. At the same time, looking at the employment market, Toronto's office occupancy is looking kind of optimistic. We've got peak day 86% of pre-COVID, and the average we're running at about 73% of pre-COVID. With that being said, we still have lower days per week than other cities. So again, city of Toronto, if you want to examine maybe the bull case for what could cause Toronto values to improve, if we see mandated 2.7 days per week that we're seeing in the city of Toronto, we have some of the worst traffic in the world. And so if people have to start working in the city, they might reurbanize their demand and move their living there, either by renting something in Toronto or buying something in Toronto. So you could see a lot of that demand from the 905 get pulled back in, or even further, where you're seeing people in 705, 519, Halifax, Calgary, etc. And you're starting to see this kind of take place organically, just in the economics of it. I'll talk a bit more about that on the rent side of things. But basically, like, people are beginning to move back to Toronto from the Calgarys of the world because they can afford to again, right? So Toronto rents are down. Toronto house prices, let's set aside house prices, but rents are down. So people are moving back from Calgary because they're like, if I can rent a place in Toronto for maybe 10% more than Calgary, why, a lot of these people are starting to come back from Calgary's, Halifax's, et cetera. And then people who got pushed from Calgary to Edmonton come back. And so again, this is how a housing cycle moves throughout the country. The one thing I will mention that's probably a big theme, a lot of people have talked about it, this the mortgage renewal wall. We're just getting to the starting of this. So this big hump, and for those of you who don't follow Ben Rabideau, I would encourage you to check out his site. He has something called Edge Realty Analytics. When we do the Q&A, I'll spend some time pulling up. I have a code. I think it's if you use it at checkout, you can get 20% off. You get the first month free anyway. But anyway, I would encourage you to check out his monthly reports. Is a great on what's happening in the Canadian economy. A record number of mortgages renew in the next 2 years. This is an observation from the Bank of basically all of these. The reds don't matter because those are your variable rates. If anything, those people will actually be renewing at lower rates. Your green is fixed term 5 years, and those are the ones where they probably be renewing at much higher rates. Everything else, your yellow and your blue, they probably are also renewing at lower rates. So you have like about half the market renewing at higher rates, maybe 60% of the market renewing at higher rates, and 40% renewing at lower. So the renewal wall is actually not as bad as it was once seen to be, because the Bank of Canada probably, and this might have been part of their policy decision, probably wanted to relieve some of that pressure on people renewing. All of that being said, CMHC delinquencies to rise in 2024. Toronto, I tried to recolor this chart because the Toronto line is was invisible, but that's the steepest line there. The biggest jump is Toronto. And so you're going to see, based on CMHC's analysis, increases in mortgage delinquencies are in the two most indebted in the country. Where in Toronto you have a huge jump up here from basically they're expecting to see mortgage delinquencies double, and then in Vancouver it would be about a 25% increase. All of that, to say that mortgage delinquencies are very low as it stands right now, anyways, and so this will lead to some power of sales. Some people choosing to sell because are making the decision on their own before they miss a mortgage payment. But I would just say this is, potentially a market opportunity for buyers who, want to maybe get a good deal, help somebody out, or, if you're a real estate professional, calling, try and get these kind of deals. Delinquencies, the interesting piece about delinquencies, and this is another chart from the Bank of Canada's mortgage market is really more of an equity-based market rather than an income-based market, because people have so much, like, we'll call it equity padding. So if you look at the current loan to value of all outstanding as of September 2024, which is the green bar here, the majority of mortgages are at a 65 or, which means that people have like in their homes. And so the market would have to fall like quite a bit before people start selling to stave off equity losses. But if people can't borrow against that 45%, which is becoming less and less because credits are afraid of risk and rates are higher, then they might have to sell simply because there is no other option. There's no way for them to realize that equity. The mortgages by amortization perspective, that kind of shows how long this pain could last. The majority of Canadians have is in kind of that 20 to 25 year range, which tells me that, we're all strapped to these high values and high rates for a long period of time. Is that if we don't diversify our economy, housing is actually going to be a net drain on the economy. We're working to pay mortgages for the next 15 years to make sure we get a diverse economy. This is the chart I mentioned that I would get to earlier when I talk about how the 1990s setup was very similar to current present day. So in 1989, you saw a peak in population growth. Actually, if you draw a line until 2022, or sorry, maybe not, I don't know. And so place was in the early 1990s was the economy wasn't good, and basically you started to see people, and that's where you see this non-permanent residents. They're actually below zero. So you saw a lot of the non-permanent residents, temporary workers, people who were maybe coming here to check out the economy, work for a little bit, stay in Canada. They started leaving in the 1990s. And that had a big impact on rent inflation in across Canada. Like this, so this is a chart 3 here is actually from the Bank of Canada, and it shows that they observed this correlation between inflation and rental price, and you can see this big drop, and then you see similarly here in 2020 during the lockdowns, you saw a lot of people leaving. The green bars down here, and you could see again rent inflation falling, and so and each rent inflation was falling in these. These weren't even drops in population, but they were just reduced inbound population. And so the next chart is scary, but this is a National Bank forecast for population growth to look like. So in Q1, I had said that rents would be falling by the end of the year, and I felt that you were already seeing them rolling over. Sorry, I think it was Q1 or Q2 when I mentioned this, but I wrote on my Substack about it. And my thought was that basically you're already seeing international students leaving in Q1. And so the government put in this policy where they were saying, "Oh, we're gonna cap international students," and it's like, okay, well, they're just trying to take credit for an economic trend. So a lot of this is just observable in data, right? And then sort of forecasted that they would do the same thing, except with non-permanent residents or temporary foreign workers, because you were starting to see temporary foreign workers leave again, or completely organically, the same way they did in the 90s. They were leaving because our economy sucked, and if they want to go exist in an economy that sucks, they want to do it back home with their friends and family, and not be displaced in a place. You started to see a lot of people returning. So to me, we've already seen a lot of the impact of this, not all of it by any means, but we've already seen like this materialize. And So the biggest way that I could see that this took place was when rent started rolling over earlier this year. So rent growth basically stopped. And in the beginning, I thought it was like close to impossible for rents to really fall, but my brain kind of changed around that as I started seeing rents coming down, asking rents coming down in a lot of markets, and and that led me to believe that we were seeing that correlation that I described right here on the right hand side play out, and I said, okay, well, population is already falling, and it was. It turned out to be that it already was falling. It just takes 3 quarters for the data to show up, and the government has to take credit for it at some point in the meantime. So we're at the point where basically negative or zero since like March of this year. And rent is, your net operating income. It's what drives prices up based on investment income. And so if rent growth is falling, there's potentially let's say less upside, more downside for values based on their income generating potential. Now, this isn't a coast to coast story. It's different on a market by market basis. So again, anything in red here, this comes from CBRE, anything in red here is markets where we've seen a decrease in rents year to date. This was basically during the year 2024, November 2024. And anything in green is markets where you saw rents increase. So the thing that you'll notice is that everything in green is much more affordable markets. Everything in red is much more expensive markets. Really not rocket science. Rents will grow, rents will fall where people can't afford to rent. Another thing that's really on rentals is purpose-built rental supply. So we're seeing supply being added to a lot of these markets. That being said, housing starts and supply is typically cyclical. So you saw the condo boom, and then you saw the rental boom after condos, but rents were still stable, and CMHC had this really good program for rental housing starts. And then now all of a sudden we're getting to this phase where we're almost like, I don't want to say overbuilt, because like I think Canada still does have a structural supply deficiency, but a lot of people say, oh, well, we don't have enough houses for people, or for all the new immigrants that are moving to Canada. And it's like, okay, well, we measure house prices in dollars, not in new immigrants moving to Canada. At least as far as I know, right? The house price always has a dollar sign at the beginning of it. And so what matters is not how many of those new people are coming, or how many Canadians are there, or how many people are moving from Toronto to Calgary. What matters is how much money those people have, and the combined amount of money that those people have. And so Calgary is a really good example that illustrates this. If somebody who sold a house in Toronto for $1 million and went to go buy a house in Calgary for 400 grand, they have a lot of money relative to, and so that's why it's pushed those prices up. Whereas if somebody moves from anywhere else in the world, and maybe they're middle class in that market, and they're moving to a very low relative amount of income. And so this is where you saw population growth putting upward pressure on rents, because a lot of those people were renting in those markets, not really buying. And so this is where the immigration thesis of house prices being broke pretty easily as interest rates started falling. As interest rates start less and less money, the banks are lending out less and less. And so prices just can't really grow in that scenario. Another very good example of this is you've got, another good example of how the housing starts can kind of dry up pretty quickly is if you look at your new condo sales in 2024, they were the lowest since the 1990s. Again, I'm making the comparison to the 1990s. There's so many data points that really make is almost identical to the 1990s. And I think that it would be reasonable to expect that we'll see kind of a similar thing. What happens in this scenario is right now we're building, the supply from maybe like these 3 bars, right? So we had a couple of years of good pre-sales, and now we're delivering that supply, 3, 4, 5 years later. We have a ton of closings, 100,000 closings from like 24 to 26, 27. So there's a lot of new supply coming in the market. Again, there's a chance that it could be relatively overbuilt for the short period of time because we have a ton of new condos coming on the market. And that's why you're not seeing rents really rising. The one thing I'll mention is we have this is the GTA, the Toronto Real Estate Board. We have had a pretty strong start to the year compared to again. We're looking more like I guess that was 2022 year, so kind of post COVID, but before we were really in this huge slump, or sorry, post rate hikes, but before we were in this huge slump. So we're kind of looking at a January that's more normal than, even I guess the big COVID drop, not as strong as the out of the gate in 2019. But again, so these drops basically are all of your Decembers that you see. So that's April, that's the lockdowns. But these little bottom December when the market basically doesn't. Toronto is the the months of inventory is the highest it's been in a while, and so we could see in a buyer's market in the spring, at least in the GTA, and so and probably for most of the year. And I think that will likely become a theme across them. So again, presents a lot of opportunity, but probably one of the first times that we'll have a really good opportunity to be agents to work with buyers where we don't have to show them hundreds of properties. Last thing I'll leave you with, sales to new listings ratio from Canadian Real Estate Association and RBC Economics. They see it as pretty much a balanced market at a national level. I would say that I agree with that at a national level. I think, again, really comes down to spring market supply and how that's going to impact the market. And I think that'll kind of decide the tone of the market for most of the year. I got about 8 minutes here to do Q&A if you want, and I'll also get the discount code anyone who wants it. David, no, that's actually let me check. I think that's MOI with everything. I don't know what on the Habistat. David, I just got to log back in. So for those of you who State Board, I use this. Actually, was on the team that made it. It's a pretty sweet tool. You just log in using your. But basically, it's a Power BI dashboard. So basically, just like a simple data science platform, charts based on things in real time. So name who was asking me there, but he wanted to see months of inventory without condos. So I can actually check that pretty quickly if I go to months of inventory here. So there's months of inventory, and then there's T3M. T3M is a 3-month rolling average. And if I go select all, which is every area on the Toronto Real Estate Board, I would go select all, and then I would go to co-op, and I think I could get rid of it so your condo is not as bad as what it is with when you include condo. So you can check pretty much any data point. Like I can change this to list price. I can change to transaction price. I can go back to 2018. This is available like right on the TREB dashboard, by the way. This is really, really good stuff for you to use to advise your clients. The economy, housing market, market. Generally, it should. The one X factor is Pierre, really ramping up, and that could be pretty bullish for Alberta's economy. It's just when does that happen? But and tariffs could probably do the opposite. I think it would be reasonable to expect that probably a positive year for Alberta's economy. So, but it, like again, if we say will it follow the market? Yeah, maybe it'll do like a little bit of a correction. Probably it'll correct away the froth. I think the froth in Calgary is kind of your like percent of gains. Wherever you see that line kind of start to get really stupid, and then I expect it to kind of correct that away, and then it usually just trades sideways after that. What is my opinion on the amount of MLI being sold in markets like Alberta? I think that it's a really good question. For context, like what this person is asking is there's a lot of these pre-made CMHC deals that are plus with 5% down. I would say you're looking at a buy, and I think a lot. Actually, there's a really good chart. Let me just see if I can here. I'm gonna click around my tape. CMHC put out this year vacancy rates for new supply. So the for new supply in this is Calgary, basically like just over 2% to over 7% last year. So new supply being like stuff that was built after 2010. So your newer buildings are performing not as well. I would say that you'll expect to see this exact thing happen in Alberta or in some of those MLI projects. So basically, what ends up happening is you get a bunch of people underwriting deals at 2%. They all go in, they use CMHC's financing, and then a year later the project's complete. They take possession, and now they're lease this thing up in a market vacancy. That's most new product is going to most new Alberta products is going to go through that motion. What ends up happening, like if you actually want to understand it, is CMHC will basically only advance as much of the loan as they'll take. Okay, so if you said NOI was 100,000 and it actually ended up being 95 or 80,000, they'll just scale it back by 5% or 20% or whatever it is to fit so they'll right size the loan, let's call it. And you, if you're the buyer, end up having to backfill that with like, whatever. And so as long as like do that, because eventually you'll have time to reel up and whatever. But if you aren't capable of absorbing the risk that I just described, which is basically like you would have to service a 2 million a mezz debt on it's not going to be $2 million, like whatever the shortfall is on your help, these deals can get ugly pretty quickly. The discount code for Edge, somebody asked me, is everyone. It should be Realist 20 for Edge Realty Analytics, and that's 20% off. Let me see what else. Performing Q1 in the GTA for first time home buyers. Probably, if for buyers, I think it'll be a good market. I just wouldn't rush to buy. I would like look around good buildings. Make sure you analyze status certificates like super in detail, so you're not getting into any hot water on like maintenance acceleration. Not exceptionally well built, or they're running into problems where you're getting like whatever, like some of your like overzealous maintenance stuff isn't working, right? Your cold plunge, your sauna, whatever it is, blah blah blah. So like really just analyze that stuff. The role of a realtor will be super valuable for first time homebuyers buying condos, but I think it'll be like you're not competing with the investor bid anymore, because they're all except for maybe like studios sub 80% loan to value. So yeah, I think it will be a good market for buyers to get into and rush them, because there's so much new supply coming on the market. And any of those people who are closing on the pre-cons that are closing this year aren't going to sell them. That's going to put stress on a lot of your older investors supply, because they're going to take, the tenants are going to go move from whatever, ice boat or whatever ice condos. I guess all the bad ones have ice in them, but they're going to move from there to one of these like a Nobu or whatever, and pay maybe even less. Those owners in those older buildings end up having to liquidate, because they either have to chase the rental curve down or sell. And so I think that the economy probably more up than the front end. But I would just be out there looking hard. Market will present a lot of good opportunity over the next 24 months. What else do I got here? Do I think that reduced immigration with increased supply of condos for now and expected supply of purpose-built rental projects could put significant downward pressure on it? Yes, would be my short answer to the question. And like we have to remember that like reduced immigration, we've already seen 9 months of that. It just started showing up in the data, but like the 10% drop that we've seen year over year in rents has already happened as a result of reduced immigration. So the trend isn't hard to see. The timing is hard to see. But this is where you really want to carefully look at supply, and then when our population starts growing again. And again, that to me, I think everything points to like a 2026, 26 ish, probably bottom. Massive changes to the economy. Thank you. No problem. Thanks everyone for tuning in. Regarding the Toronto supply of condo coming through buildings being finished, uh, when do you anticipate a shortage of supply and a rebound in condo price? I mean, the supply shortage doesn't occur until like 27, 28, 29. That's when it starts. Like that's when we're building less, but we'll still be absorbing all this record supply during that period of time. So to me, like, first of all, I honestly don't actually think that the condo market, the pre-construction condo market, will ever go back to where it was. I'm sorry to all the people on the call who are not going to like that comment, but what we're learning right now is that it was a broken way of delivering housing and fundraising for housing. And purpose-built rental is actually turning out to be a much better one. And developers should be landlords. We want large institutional landlords, maybe having thousands of foreign investors who aren't here owners of our rental supply wasn't the greatest thing to start with. So what I will say is I think the condo eventually, when the condo recovery does start, because I don't want to try and nail the timing, but I would say probably like you're literally looking at like 29, 2030 or like 2030, to be honest with you. Like gap actually arrives, right? Um, uh, what'll happen is a lot of that will get backfilled by rentals because if rents start rising again and construction costs and project or let's say total creation costs are reduced through whatever DCs, HST, financing, etc., builders are just going to build rental. And especially if investors aren't lining up to buy pre-con projects. And so condos will actually be gradually become more and more of a scarce piece of the total supply. So that's probably the recovery scenario for condos, is that we end up moving to a rental uh, market like New York as an example, where there's a lot of apartment buildings, and condos like scarce kind of outlier housing product. Um, the Also with a lot more rental being constructed, does that counteract that? I guess I kind of answered that. From Missy Scott, you kept referring to the 90s and that you were mirroring that time. Do you think that we'll see a drastic decline in home pricing occur over the next 12 to 24 months? My guess would be like we probably have 5 to 10% downside left in the Toronto market. If you go back to that chart, I think I mentioned that when we were, let me just go, I'll go back to the link. How did I get to this? Sorry. Um, if you look at the point in time where we're at right now, from there, we really only saw another 5 to 10% downside after that. So I would say most of the correction that we're going to see is behind us. And people, when I say that, they think that I mean that all of it is behind us, but I don't feel that way. I think that most of it is, and you can see most of it. Most of it is that steep ass line that was really painful to go down, and then after that, you see this like kind of just slow grind down. And like again, if you look at Vancouver, okay, maybe we got 10 to 20% more downside. This is just an index, by the way. So you start at 100%, you drop here 10%, you drop to where we are right now. It's, I don't know, whatever, 13%, because we're 87%, let's say. So yeah, you maybe go down to 82. So you're, 28% off the top, which is, I honestly thought like 30% peak correction, that the setup that we're likely to see, just from the very beginning. I wish I had different news, but I'm going to avoid that being the scenario. Do I have anything else here? I think that's it. I hope I got everybody's questions. Just like send me a DM on Instagram, whatever. There's another one, I guess the last one, how to age demographics play in here. One thing that I'll mention in regards to that, what boomers do with their houses is probably going to be, like the defining factor in Canada's long-term picture for the real estate market. So age demographics could, like when boomers downsize en masse, and most of them probably won't, to be honest. Like every time I cold call a boomer, they're like, I want to die in this house. It's like, okay, cool. That's a little morbid, but like, so it seems like that's the sentiment. But if something happened where maybe there was a good product available or switching costs went down or something like that, that's a lot of oversized supply that my generation can't afford, that could hit the market in a big hurry, and that could have further downward pressure. But that's like we're talking about, but that's what could kind of really, really put a damper on a recovery scenario in Canada. So that's when I would watch closely. Supposedly 50% of the market is first-time home buyers. Do you think that a lot of young renters will buy condos in the next 12 to 24 months? I do. What a lot means is tough to say, but I do think that you'll see, I mean, as the gap between renting and owning shrinks, and people inflation with a question mark. Yes, I think wage growth is at like 3% and inflation's at like 2.6. Um, yeah, I think that's it. We will share this as well. So if anybody wants a copy, I'll see if I can just send a link out to everybody who's registered, but we'll also host it on the website. I think that's everything. Thanks a lot, everybody. Really appreciate your time. Yeah, see you next month. Hopefully with some better news, but probably not. Anyway, enjoy your tariffs between now and then.